With that, uh, we come to the sessions that we are lined up for today. We have two very enlightening sessions for the day. The first would be Something of Value by Howard Marks, and the second would be The View from Washington from David Rubenstein. The first session would be from Howard Marks, who is a co-chairman of Oak Tree Capital Management. This session will be moderated by Shankaran Naren. A brief intro of Shankaran Naren, though he does not need any introduction. But Mr. Naren has been in the financial services and investment management industry for the past 27 years in various roles across multiple organizations. He is the Executive Director and Chief Investment Officer in his current capacity at ICICI Prudential AMC. Naren is known to be a very contrarian and value investor. His mantra is to identify a theme, neglected sector, or stocks before the market has a whiff of it, and wait it out till the idea starts seeing the limelight and the light of the day. Naren regards his expertise and knowledge that he has gleaned from teaching of his three gurus, James Montier, Howard Marks, and Michael Mauboussin. We were very fortunate to have Mr. Mr. Michael Mauboussin, who have addressed the audiences yesterday. And today we are very fortunate to have Mr. Howard Marks, who will be listening to. And I think none other than Mr. Shankaran Naren would have been a better choice to moderate this session. So with that, I hand over the session to Mr. Naren. Mr. Naren, the screen is yours in a virtual world. Thank you so much. Over to you, Mr. Naren.
Thank you, Mr. Kishore, for the introduction. See, for me, it's a dream come true to have this conversation with Mr. Howard Marks. When the 2008 global financial crisis happened, and then subsequent events, I had not read much about Mr. Howard Marks and OaktreeCapital.com. So, subsequent to the global financial crisis, when I read about Howard Marks and OaktreeCapital.com, it was just too fascinating. Mr. Howard actually was a person who started his career in Citigroup and went into, after doing his MBA from Wharton, and went into equities, and then subsequently went into distressed debt. And in my opinion, the kind of effort that he has taken to educate the world on financial investing is, in my opinion, only Warren Buffett is the only other person who has actually surpassed him in this entire area. Because, when you read OaktreeCapital.com's memos written by Mr. Howard Marks over the years, frankly, there is such a wealth of wisdom. And in the period after 2010, I have told so many people in India to read those memos, because what is great about those memos is that he has not used financial jargon like return on equity, return on invested capital, IRR, or any of those kind of jargons in his memos, and therefore he has helped improve financial literacy for a wide variety of people. So when I was thinking about this event, I was just thinking Queen Elizabeth, after the global financial crisis, asked many economists, why did you not see it coming? And the economists did not give a proper answer to Queen Elizabeth. But actually, if Queen Elizabeth had pointed out and decided to meet Mr. Howard Marks every year, I'm sure she would have had all the answers before the global financial crisis. And that is the beauty. And the two books that he has written subsequent in the last 10 years have been pearls of wisdom for many of us. And I would request all investors and even non-investors who are concerned about their finances to actually read those two books that have been written by him in the last 10 years. I think, thank you, Howard, for educating the world about investing in the last decade. And thanks CFA Institute for giving me this opportunity to talk to you this year. I think we've had an amazing year. How did you ever imagine in March that this is where we would be in January 2021?
Absolutely not. Before I answer your question, let me say how glad I am to be here today and how very glad I am to be interviewed by you, because I know you have a great understanding of the ideas that I have put forth. And so it's really a pleasure. I'm a great devotee of the CFA program, and I meet with as many societies as I can. And of course, speaking with the CFA Society of India, it's a great honor. It's the furthest from my home that I've ever been, thanks to the wonders of virtual presentations. But you know, there are approximately 150,000 CFAs in the world today. I'm very proud to say that my CFA certificate is number 3,000. So 98% of all the CFAs have come after me, and it's a great accomplishment for all the societies. And I have a strong feeling for India. My book, Mastering the Cycle, was, what shall I say, caught in a rut. I started it, and then I put it down and had trouble getting back to it. And then I made a visit to India in 2017, and that helped me renew the effort. And eventually, of course, I completed it, and it was issued in 2019. So thank you, India. Thank you, CFAs, and thank you, Mr. Naran. So you asked about foreseeing these things, and as I'm sure you know from reading my materials, as you have, my saying is we never know where we're going, but we should know where we are. And the truth is that where we are has implications for where we're going. It doesn't tell us exactly where we're going, and it doesn't tell us when we're going. Nobody knows the timing on these things. But if we are aware of what's going on in the world, the investment world, it has implications. It gives us a hint. It tells us what I describe in the latter book on the market cycle. It tells us what the tendencies will be, the probabilities. And the key was that in 2006-07, I was convinced, these feelings usually are generated out of my conversations with my longtime partner, Bruce Karsh, who joined me in 87. So we're coming up on 35 years. You know, we talk about the environment, and the conclusion back in 05, 6, 7 was that the world, the investing world, was too generous, too undisciplined, very poorly constructed and poorly conceived, and over-levered, and risky deals could be done with ease. And when that's true, what that means is that investors are not applying sufficient discipline. They're not behaving in a manner which is sufficiently risk averse. They're buying risky securities without sufficient compensation. That's all you have to know. You don't have to know exactly what the implications will be. You certainly don't have to know when the problems will emerge. But if you know that the world is an undisciplined place, that the market is too hot, that risky deals can be done, that's enough to know that you should adopt greater caution and behave in a more risk-averse way. We did that. We knew. We reduced. We sold a lot of assets. We reduced the size of our funds. We wound down large funds and issued small funds, and we increased our selectivity, our standards. And of course, that was the right thing to do heading into the global financial crisis of later 07, 08, and early 09. And that's all you had to do. And it was not that hard. if you were reading the news of the day in a critical fashion. So that's the kind of thing we do, and it works. We're not fortune tellers. We have no unique crystal ball, but it's as I say, it's hard to predict the future. It's easy to predict the present.
So, after 2008, the global central bankers seem to have taken control of the markets completely. And, in India, there is a famous epic called Mahabharata. In that epic called Mahabharata, there is a famous warrior called Arjuna. In that Arjuna's son once knew how to enter a formation and did not know how to come out of the formation, and called Chakravyuh. So in the last 12, 13 years, the central bankers have actually kept on buying assets. And today it has reached trillions of dollars of assets now across the world. All the central bankers have bought. And do you think that they will be able to ever do a soft landing of all the assets that they have bought without causing market damage on a big way, or whether without causing a crisis of unprecedented proportion?
Well, that's a great question. I realized while I was listening to you asking me that I still owe you an answer, because your last question was really not about the global financial crisis. What you had asked me is whether in March of 2020, one could have imagined where we are today. And I still owe you the answer to that question. So I'll answer that question first, then I'll come back to Mr. Maharabata. And the answer, of course, is no. A lot of what I write about is really what I call pattern recognition. Understanding, Mark Twain said, history does not repeat, but it rhymes. And the patterns are what rhymes. And historically, the lofty markets and risky behavior have given way eventually to weakness. And that weakness has traumatized investors and been long lasting and painful, and produced large levels of defaults and great amounts of securities for sale and urgent selling on the part of panicked holders, and great opportunities, for example, for the distressed debt and buyer, which is a lot of what we do at Oaktree. So in 2020, we had the beginning of that. We had the market was at, I think, a somewhat precarious level, and prospective returns were low, and the securities were high, and there were risks in the world, and investors were engaging in risky behavior in order to achieve high returns in a low return world. All of that described 2019, 2020, 2018, 2019, the beginning of 20. And then, of course, the pandemic hit, and we had, securities cascading down, and we had dire predictions for the disease and for the markets and the economy, and everything looked very, very bleak from the all-time high of the S&P was reached on February 19th of 2020, and the low on March 23rd, and in between, the S&P fell by a third, and it looked like another repeat of a crisis, with all the things that I mentioned, and with prices likely to cascade downward for a long time, and with high defaults and vast amounts of security for sale on a forced basis. And nobody would have guessed on March 23rd that we would be here today, that the stock market would be substantially higher than it was only 10 months ago, that that speculative and risky securities would do the best coming out of there, and that the high tech would be up. The S&P is up 70% from the low of March 23rd. The high tech stocks are up much more than that, and the people who invested in tech and also high risk securities have more than doubled their money. Nobody would have thought it, including me. So it just goes to show that we never know what's going, what lies ahead. And this time, the people who put on risk 1 month into the crisis are the ones who made a lot of money. So it just goes to show you that this is not an easy business. And nobody ever has all the answers. Some great investors were saying at the low that things were risky and would continue downward. And of course, they're wrong. A lot of people missed the last 10 months of recovery. We actually became aggressive in March, not because we knew it was going up, but we thought it had gone sufficiently down, and that's all you can do. So now, your question about the market conditions. Will you remind me about Mr. Marabata?
On my second question, do you think central bankers will be able to take us out of this? They have been indulging in similar behavior from 2008 onwards, and the same behavior they've been doing. Will they be able to ensure that we are not into trouble, or one day they'll make a big mistake?
Right. Well, look, I think, I worry about that. As you say, actually, I think that Greenspan was the first super activist Fed chairman, and he began in the 90s, and he took the approach that he would prevent all weakness. And so every time there was a problem, like the busting of the telecom bubble, or an anticipated problem, like Y2K. Most people don't remember, but back in 1999. In 1999, we were thinking about what would happen when 2020 rolled around, and the date in most computer systems, where the date was ending in 98 or 99, and the calendar would roll over, and we'd pass the century mark, and the new date would end in 00. And we worried that were computers set up to make the transition from 99 of one century to 00 of the next century? And everybody anticipated a Y2K, that is year 2000 problem. And in anticipation, the Greenspan Fed injected further liquidity to prevent there being a problem. And the point is that the Fed has been activist ever since then. People concluded there would be a Greenspan put, which would solve all problems. And I think it's worrisome to have investors expect that all problems will be solved, so they don't have to worry, because that produces excessive risk tolerance and pro-risk behavior and moral hazard, in which people figure that they can take very high risks, because if they're successful, they'll make a lot of money. And if they're unsuccessful, the Fed will bail them out. And of course, the Fed did bail out the global financial crisis with bank bailouts, cash injections, liquidity, security buying, and so forth. And in only a few months from the Lehman bankruptcy in September 08, within 6 months, starting in March 09, the low point was reached and the markets went up. And of course, the markets have gone straight up from March 09 to March of 20, 11 months. bull market. Now, the things they did in months in the global financial crisis in 08-09, they did in weeks and days in the pandemic crisis of 2020. And again, the market has gone up and the people who took risks have been bailed out. And the Fed is committed, I think, to avoiding recessions and offsetting weakness. And I think your question implies to me that you're skeptical of that, and I am skeptical of that. I worry, what does that mean? Is it, the Fed has a lot of responsibilities. One is to make sure that that inflation is not excessive, to achieve price stability. Another is to make sure that there are enough jobs to supervise economic growth and job creation. And when you start adding additional responsibilities to prevent recessions, to solve all weakness, more recently, Americans have been talking about charging with the central bank with reducing racial and economic inequality. How many responsibilities can the central bank acquit simultaneously? And can we count on the central bank to prevent recessions and weakness? And is it legitimate? Can they do it? And are there ill effects? With forest fires, there used to be that they would permit small forest fires to take place, and it would burn up the fuel in the forest floor. Now, the new philosophy became to prevent small forest fires, which means when you have another forest fire and it gets out of control, it'll be very big. And we've had these enormous forest fires in recent years, which have really been extremely bad, especially in California. But this year it was bad across the whole West. So I worry. I think it's unrealistic to say that the central bank will eliminate economic problems and meltdowns and crises and recessions. And if people expect them to do so and act on that advice, then they will behave in a risky manner. And when the recession comes that the Fed cannot eliminate, we will have a severe crisis. I tend to agree with the thinking that I think is implicit in your question.
In the last 1 week, we have seen even more bizarre speculation, like what has happened in some Reddit groups, and those Reddit groups lead to massive rallies in some junk stocks, which are over short sold, etc. Now, this level of speculative excesses we have seen back only in 1999 as such, and we have had the most supportive monetary policy. So somehow all these gives us sinking feeling in our stomach sitting in India, where we have not had this kind of excesses in equity markets, but we worry. So how much to worry? That's what we keep thinking in India.
Well, one of the things that happened in the last year coming out of the pandemic market crisis has been the behavior you talk about, in strong involvement in the markets by retail investors, some of whom are working through Reddit, through Robinhood, and so forth. And I'm not an expert on these matters, but we are seeing what look like excesses in the trading of GameStop, which goes up 100% a day and then down 80% and so forth. Really volatile trading, and we saw it in Kodak. Kodak was bankrupt, and somebody reached the conclusion that Kodak, which was maybe $1 at the time, was worth $4, and so the stock went way up. And the point is that a bankrupt equity really has no value, and the idea that it could be worth 4 times as much as it was trading for seems off base. So, I think that I wasn't around in the 1920s, and so I'm not sure it's the same, but certainly there does seem to be speculative behavior on the part of some retail investors and activity which is not related to the fundamentals. And we as CFAs think that we should base our investment decisions on fundamentals, and investing should not be a sport or a game. But people are investing to have fun, and trading for fun, and trading without knowledge of or reference to the fundamentals. And in GameStop, for example, it seems to me, untutored in these matters, that people are having fun by trying to run up a stock which a lot of people are short, and attacking the shorts, like a crowd or a mob behavior. And so this is, of course, is worrisome. But I will say it doesn't affect most of us. Only very few stocks are affected by it, and it's not, I don't think, a widespread phenomenon. And I don't think, if these retail players gang up on one company, they can have a profound effect by putting the stock up or down. But they don't have enough money or power to affect the broad market or many stocks. So I'm not worried about it as a systemic issue.
What is your current view on Bitcoin, the most complicated financial asset at this point of time?
Well, I'm sure you've read my latest memo, Something of Value. And I talk in there about the fact that when Bitcoin and other cryptocurrencies first came to the public attention, which I think was in 2017 in a substantial way, I came out and I shot from the hip, and I announced substantial skepticism, and I had unkind words for Bitcoin. And the memo, Something of Value, the reference to Something of Value really is a reference to the fact that in the pandemic, I had opportunity to live with my son and his family. They came to live with us in California to escape the pandemic that was very running high in New York. And so, he straightened me out as our children do, and he made clear his belief that I had, number one, been outspoken on cryptocurrencies without having much knowledge. He thinks that I was reflecting the fact that, number one, I came from the parents who lived through the Depression of the 30s. Number two, in my first decade of investing in my career at Citibank, I was traumatized by the collapse of the Nifty 50. The best companies in America, in the late 60s, if you bought them, in the early 70s, you lost almost all your money because they absolutely collapsed. He also thinks that, I've made a lot of money as a distressed debt investor by profiting from things like the global financial crisis and so forth. I've managed money through now four debt crises, and very profitably. So and to be an investor in low grade fixed income securities and in distress, you kind of have to be a bit of a skeptic. So my natural knee-jerk reaction is skepticism. So he thinks for all those reasons, I shot from the hip and unfairly castigated Bitcoin. And I'm not saying that I've changed my mind or that I'm recommending Bitcoin, but I'm trying to get more knowledge under his aegis. And I've learned a lot from him in this period about myself, about investing, and so forth. And so I'm not. I don't have an off-the-cuff reaction to Bitcoin for you. I don't have an answer. All I would say is that I'm now more open to researching it. And whereas I back a few years ago, I was down on it because I feel it doesn't have intrinsic value or cash flow. The truth is, all currencies lack intrinsic value. All currencies are only they only work because they're accepted, and they're accepted without intrinsic value. They're accepted because we think other people will accept them and accord them value. And I think the same is true of Bitcoin. Bitcoin does not have intrinsic value, doesn't have asset value in itself because it doesn't produce cash flows, like many other assets which are only the subject of supply and demand. But Andrew's introduced me to the Bitcoin community and Bitcoin aficionados, and they argue that the supply is fixed, that under the regime of the program, there can only be 21 million Bitcoin. There are already 18.5 million outstanding, so the supply can only go up another 15%, but the demand, they say, can go up a great deal. And Bitcoin is in increasing demand in the third world, in people who don't have or don't trust bank accounts, who are leery of governments, who are worried about excessive money printing, and people who will use it for store of value, for exchange, for purchases, and also some institutional investors and some banks, et cetera, are getting involved in cryptocurrency and legitimatizing that. So that I know now that there's a positive case for it. I better understand the positive case. I haven't reached a conclusion. Nobody should take away from this that I'm recommending it. But I'm seeing the error of my ways in being a knee-jerk skeptic and trying to not do that in the future.
You wrote a book on cycles, but your latest memo, for example, you worry that you may not see cycles in some of the technology stocks.
No, I'm sure we will see cycles. And, they've done great in the last 10 months from the low of March. Now, many of them were proved as to their fundamentals in 2020. Obviously the world went through a horrible experience in 2020. We're still not out of the woods with regard to the pandemic, although we believe that the vaccine will work and eventually will achieve herd immunity. But many of the tech companies actually thrived in 2020, whether it's Amazon with home deliveries or Netflix with streaming of videos and so forth. Many of the tech leaders did extremely well in 2020, and software companies and so forth. And so the stocks have done extremely well. Many of the stocks seem to be highly priced. Now, I certainly don't know enough about them to reach that conclusion. But of course, many of them have A, done very well, and B, are selling at historically high multiples of sales and so forth. So, one of these days, when the optimism is drained from the market, they'll have weakness. I think that to think that these stocks will go straight up forever in the future, and that they won't experience any cyclicality, there won't be a market cycle in the tech stocks, I think that's a mistake. I think that there certainly will be sometime. They'll go down substantially, but they'll probably recover. And if you take a long-term view, I think they'll on average, they'll do well for a long time. There will certainly be some bad experiences along the way. But, my son, Andrew, argues, and he's probably right, that in the long run, the successful ones will be very big winners from here. And that the right, of course, the hard part is you have to figure out which they are. And they certainly aren't all going to be the winners that they're thought to be today. But if you figure out which the successful companies will be, and you hold them for 10 or 20 years, you'll probably make a lot of money. And his big argument is that given that fact and that truth of the long-term outlook, that you shouldn't get off in the short run just to avoid a downturn. And I think that argument makes a lot of sense. You know what he says. I wrote a memo on liquidity back in 2013 or 14 or something like that, and maybe it was 15. And he said to me, Dad, if you look at the chart of a stock which has been up for 20 years and has gone up many, many, many times, and you say, man, I wish I had that stock. He says, think of if you bought it 20 years ago, think of all the days you would have had to talk yourself out of selling. And the truth is that in the stock of a company which has a great long-term future, a growth stock with great products and management and trajectory and so forth, it's desirable to hold for the long run. And in the interest of holding for the long run, I think it's important to not try to adeptly get in and out and in and out and in and out, because nobody can do that repeatedly correctly. And it would be nice if you could. You probably can't. So probably the best thing is to hold for the long run in the stocks of the best companies that will do well in the long run.
You've been a distressed debt investor in US and a very, very successful investor. What's your experience of distressed debt investing in emerging markets? Do you think they'll let you make money smoothly? Your experience, and which are the other emerging markets where you can do distressed debt investing?
Well, we first of all, maybe not smoothly. And if you look at we started in '88. We started the first distressed debt fund, and I think that was the first distressed debt fund from a mainstream institution. We've been doing it now for 33 years, and I think we've had more funds and bigger funds and more money than anybody else in the world, I believe, of fund managers. We've had a successful ride. We've had a good long-term average return. We're very proud of it. But I will tell you that the returns over those 33 years and probably 20 funds, I think, or roughly 20 funds, the returns have been extremely unconstant and extremely variable. So nobody can say smoothly. On average, very successfully. On average, very high return, but I would never use the word smooth to describe our experience. Now, as for the emerging markets, I would say ditto, maybe more so. In particular, we have been active for the last 5 years, roughly, in Chinese NPLs, one of the biggest in the world, if not the biggest. We may have been the biggest. We are continuing to be active there and to increase our level of activity, and we do this out of our Hong Kong office. Our head of non-US distressed investing moved 2 years ago from London to Hong Kong to do this. That's an important commitment of our resources, and we've built a team in Hong Kong which is active in China. And we considered the experience very successful. More recently, we began under that man's supervision from Hong Kong, but the direct investing is done out of Singapore for India. And we've been active in India. We've invested in areas such as commodities, telecom infrastructure, residential and commercial real estate, and oil and gas. And our activities in India have moved up, and they are at scale now. And we were we made substantial commitments in 2020 in the global pandemic, and those investments look like they're successful. You and my Indian friends know that we've been engaged in pursuit of an investment with a non-bank financial company in which we were not successful in getting it against Indian competition. And it was a big story. I was getting news every day about that battle, which was unsuccessful for us. So, we're not successful all the time, but we believe in India and India's long-term future. And after my visit, which I described in the book on the market cycles, and lying in wait and in bed and unable to sleep and thinking about India, I came to a positive conclusion about the long-term future, and it probably will not be again smooth. I think India has great potential, and we'll be there, investing certainly in distressed debt from time to time, but also probably in other forms of investing on a non-distressed performing basis for the long term. So I think that certainly India and China, you'll see Oaktree substantially. Other emerging markets are smaller, usually don't have much of a debt infrastructure, and we're unlikely to be there in a very large way anytime soon. But we have experience successfully investing in many emerging markets in a small way from time to time.
Do you believe inflation is really low in the Western world and Japan and Europe, as is being told to all of us, or actually inflation is much higher?
I'm sorry, ask that again, please.
No, everyone tells us we have deflation in the Western world. Inflation is very low all the time in the Western world, in Japan and US, etc. Is it really true inflation is low? Is inflation something measured properly in the Western world and Japan and Europe, or actually inflation is higher?
Well, I can only speak for America. I haven't studied the calculations in other countries, but I think that inflation is very hard to measure, as you imply. Number one, for example, home prices are not treated right, because home prices are treated more on a rent basis than looking at home selling prices. Number two, it's very hard to reflect. We know that the prices of computers, for example, have done XYZ over time, but the computers have gotten better during that period. So the behavior of the prices may not reflect the value that you have received, and thus the price for a unit of value in computers and other things. We know that when I look at the prices I pay for suits and cars and paintings and things like that, we know that the price experience of luxury goods has been quite inflationary. And we also, of course, know that there's been a great deal of asset inflation, which has implications for price inflation. So I think it's hard to measure inflation. And, the statistics say, as you say, that Europe and Japan, but also the US, have been desirous of inflation. And that in Japan, for example, they've tried to have 2% inflation for over a decade, and they haven't been able to achieve it. And the word I used to apply to inflation is mysterious. We don't really know what causes it. We had inflation in the US in the 70s, and we didn't really know what caused it. And it seems to be largely psychological, and the psychology seems to be largely self-reinforcing. and the source of inflation and it seems to be mysterious. We haven't had deflation in general, but we certainly have not had much inflation, and nations that want it can't achieve it. You know, a little inflation is desirable. It imparts a growth to the economy because it causes prices to rise, and the combination of real growth plus a little inflation makes an economy more vibrant, or at least seem to be more vibrant, but I think more vibrant. And it also, the other thing is, if we have inflation, which means that purchasing power declines over time, we can repay national debts with currency that has reduced purchasing power, which, in other words, we can pay off our debts a little cheaply. So we want a level of inflation, and so far we have not achieved a level of inflation in most of the world. But that doesn't mean we will not have inflation. And particularly in the U.S., for example, in the last 10 months, we've injected 5, 6, 7 trillion into the economy through the central bank bond buying and Treasury deficit spending. And the question is, can we continue to behave in that manner and not cause inflation to be rekindled? The banks, number one, may believe they can do so. Number two, I think they believe they have to spend that money in order to prevent global depression. And I think it's true. And I think that back in March, I remember feeling around March 18th, for example, that maybe we were on the way to global depression. And my partner, Bruce Karsh, and I had significant discussions about that possibility. And then, of course, the Fed and the Treasury bailed out the economy with their bond buying and liquidity injecting and interest rate cuts. I think they had to do these things, but I'm not convinced that they will be without consequences on the inflation side.
About 10 years back, Carmen Renat and Kenneth Rogoff wrote a book saying that if government debt goes above a certain level, economies will slow down. Actually, today, government debt is much higher than what it was 10 years back. How will these government debt of such unprecedented proportion get paid? And is there any negative problem at all that we should worry about with this kind of government debt in the Western world, particularly where populations have ceased to grow?
Well, look, there is a new theory abroad in the land called modern monetary theory, which says that for a country like America, which has control of its currency and can print more, deficits and national debts don't matter. Seems simplistic to me. It seems Pollyanna to me, overly optimistic. And, I'm not an economist. I don't claim to be one. It seems to me that we can't do these things without consequences. But so far, as you say, we haven't had the inflation. And so far, our debt level is probably above the one that Mr. Rogoff talked about, and yet no ramifications so far. So I don't know, but it seems to me that it's too good. It's too good a thing to think that you can print all the money you want and not have to pay the piper at some point in time. So I'm worried. I don't think there's anything we can do about that worry. I'm not going to fail to invest. I'm not going to sell my securities. I'm not going to get in a hole and pull the dirt over me. I think we don't know what the ramifications will be. We certainly don't when they're hit. I think that we should behave in a cautious manner, but not fail to invest. I've seen a lot of people over the last 15 years or so who had allocations in their portfolios to fight inflation, and they wasted their time, and eventually they eliminated those allocations because they gave up on inflation. Now, it's possible that they give up on their inflationary protective assets just in time for a bout of inflation. That's usually the way it works, but it's very hard to allocate much money today to fighting inflation.
So years like 1999 in the tech boom, or 2007, or to an extent even now, how do you stay rational if you think valuations are excessive and handle the emotions around you? What is your suggestion to all of us who are all not as experienced as you, and some of us handle other people's money, some of us handle our own money, and it becomes very difficult because there are periods like, how did you handle it, and what are the lessons you can tell us?
Well, that's a great question. It's one of the most important questions in the investment world. I think that the great investors that I've gotten to know over time, one of the common threads is that they're not emotional. Emotion is a great enemy. Human emotion conspires to make us do the wrong thing at the wrong time. When things go well, people get excited. They make money in the security market. They're encouraged by positive developments in the economy, and they buy more. And they're also excited because they see prices rising. So the more prices rise, the more they buy, until we reach a top when they run out of money to spend, or things start to turn down and they're discouraged. And then as things decline, and as there's bad economic news and bad corporate news, and security prices go lower, people get depressed and worried, and they sell. And as the lower things go, the more they sell because they're panicked. And so if you think about that for a minute, when times are going well and prices are high, they buy. And when things go poorly and prices decline, they sell. Well, my mother told me, buy low, sell high. Emotion makes you buy high, sell low. So it's clearly your enemy. And we have to get control of our emotions. And if we behave and are the victim of the same emotions as everybody else, then we'll perform no better than others. Our job is to perform better, to have above average returns. And we can't do that if we're victimized by our emotions. So we must behave in a non-emotional way. And when we see euphoria, we have to turn cautious. And when we see panic, we have to turn aggressive. Not easy. I think we've done it successfully. And this is what our clients credit us with, and why we've been able to build a big company. But it's not easy. And I can't make it easy. Obviously, there are two choices. If you want to be unemotional, either be born unemotional or teach yourself to be unemotional. Believe me, the first one is easier. I think I'm an unemotional person by nature, so it's been rather easy, relatively easy. I don't want to say it was easy, but I mean, the point is, when Lehman went under, I think we had raised the largest distressed fund in history. The money was sitting largely on the shelf. We had started raising it in March 07. We stopped the process in March 08. We had $11 billion for our fund 7B. We didn't invest it for several months. We started in a small way in June of 08. The fund was, I think, 12% invested the day Lehman went under. Then we turned aggressive, and we invested $450 million a week on average. And by the end of the year, after 15 weeks, we were at 70% invested. We had invested 58% of 11 billion, which is $6.5 billion in 15 weeks at very low prices. And that's all you had to do. You didn't have to be selective or agile or disciplined. All you had to do was have money to spend and the nerve to spend it in the last quarter of 08, and you were very successful. But the key, of course, was to be able to become aggressive in very difficult situations, and that required emotional control. And I wrote in one of my memos that I was speaking with a reporter from one of the leading newspapers, and he said, well, what are you doing in this dire environment? I said, we're buying. He said, you are? Like we were crazy. But of course, that was the key to success. So I think that emotional control is very important. In order to achieve emotional control, you have to understand the importance. All problem solving begins with understanding the problem. And we understand that emotions are the enemy and that emotional control has to be the goal. And fortunately, we've been able to do it.
Thank you very much, Ward Marks, for a wonderful, engaging session where I could get such a wide variety of questions answered on a wide variety of subjects. It's my deep pleasure on behalf of CFA Institute of India for getting your valuable time to share it with all our institute members and others. Thank you. Thank you very much.
Well, Mr. Naren, it's been a real pleasure. As far as I'm concerned, the time has flown by. You always ask me great questions, and it's a pleasure to be here with you today. Thank you, and hello, everybody in India.